And now for something completely different.
It's a Rick world.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the show. Of course, it is the first day of August as we've now moved into the worst month of the year. No, that's not meaning you have to go back to school. Although, if you ask my daughter over the weekend, she's already dreading it. She was in just distress all weekend that school's getting ready to start in 2 weeks.
Isn't she a senior this year?
No, that's my youngest daughter. She's a freshman. I have two seniors and a freshman this year, and then of course my oldest is now living in Germany.
I can sympathize with the freshmen.
They're all moving through.
Yes.
So I see light at the end of the tunnel.
Empty nester, yes.
Big savings down the road coming up. Out of the house at 18, not my job anymore. Anyway. No, I don't mean worst month of the year for going back to school. Technically, August tends to be one of the tougher months of the year for the market. And of course, this is also particularly the case in the first year of a presidential cycle. And if you didn't read our newsletter this past weekend, it is also interesting from the fact that we've now had 6 straight months of up markets, right? So the market has not had a negative return in 6 months. Now, that doesn't, I mean, you go, that's great, right? Market just goes up every month. Well, that's true, but things just don't go up every month. You're going to have some negative months in here along the way, even with just normal bullish markets. 6 straight months is actually a very long streak without a negative month. So August and September tend to be in the 2 months of the year that typically have a negative rate of return. So just not trying to tell you to go sell everything, go to cash. I'm just kind of giving you a heads up here. Markets are very extended here. We've had a great run in the markets. Would not be surprising. We've talked about this before, that you're going to have a little bit of a correction here at some point, and just something to be aware of. Now, you know, the current trend that we have in the market is fine at the moment. Markets are going up. We talked about last weekend before last that we were back onto our money. I'll spit that out this morning. Money flow buy signal, right? Back on that signal. So that means that markets were more bullishly biased. And we said at that point, though, that markets didn't have a whole lot of upside, right? So, and really not much has happened after we bounced off the 50-day moving average and triggered that buy signal. Basically, markets really haven't done much. They just kind of went sideways last week. So again, I think you can expect a little bit more of just this kind of sideways churn here for just a bit. Now, if we do start getting into, and we'll talk about this in just a few minutes, but you know, if we do start getting into some more negative news cycle here over the course of the next, couple of weeks, there is risk to the downside. Look, we're very extended from the 50-day moving averages. We're very, very extended from the 200-day moving averages, and we have not had a correction of 5 to 10% in a very, very long stretch for the market. So my point is simply that, just be careful. Low volatility, we talked about this last week on the show, even wrote an article on it talking about the next Minsky moment. Low volatility, what Hyman Minsky talked about is that periods of stability where there's very low volatility tends to lead to periods of higher volatility. Now, does that mean the market's going to crash? Absolutely not. It just means that you're going to have bigger potential drawdowns. That's all that means. So just something to kind of pay attention to relative to your money. Now, what could happen here over the next couple of weeks in particular that might kind of disrupt the markets? Well, we've got a lot of negative news kind of coming through the cycle right now. It's been kind of underneath the surface. Nobody's really paying much attention to it. GDP was reported on Friday. We'll talk a little bit about this morning in the next segment. We have an article out this morning called The Grossly Defective Product. GDP came out exceptionally weaker than expected. But Lance, it was 6.5% growth for the second quarter. Yes, it was. But it was expected to be 13.5%. So we had a tremendous drawdown on economic growth, the economy not growing nearly as strong as expected. Personal savings, personal spending all revised down in these revisions. So again, things not quite as exuberant as, people have thought, at least or at this point, but they've run up prices in anticipation of these better than expected numbers, which didn't materialize. So this really puts markets at a much bigger valuation risk, particularly with earnings and sales going forward. But coming up this month in particular, over the weekend, COVID right? This is kind of the next Cold War potentially for the markets, because COVID is now starting to rear its ugly head again. This is starting to put a little bit of pressure back on decision makers about potentially, locking down activity. And I don't mean that necessarily from the standpoint of we're going to shut down the economy again, but if you start requiring mask mandates, these type of things, which is a very real possibility, at least in some states, probably not in Texas, but at least in some states, that's going to potentially limit outside activity, right? People are going to start to say, well, maybe I won't take the risk. And so they make a decision not to go out, not to go to bars, not to go to restaurants, not to go to sporting events as we start to get back into football season here right around the corner. That could potentially start to reduce that activity. And again, just the decision-making process of this virus as it's kind of starting to come back up here again. Hey, you've got a vaccine, awesome. You can still get the Delta variant. So again, even if you're vaccinated, as a good example, both of my wife's parents are vaccinated. They both have COVID right now. So again, it starts to make people think about, well, am I going to take the risk? Even if I'm vaccinated, well, I'll take the risk. So I won't go out to a restaurant, right? That's the type of potential that we could potentially see here as people make the decision not to take on activity. And that also starts to limit potentially earnings growth expectations as we move into the last part of this year. Now, there's some benefits to that as well. People move back to shopping online, of course. So there's always some beneficiaries, of any action. Of any action, there's always a reaction. So you always have to look for in the markets where that activity may shift to. So we may see activity shift back more towards Amazon, which got absolutely beaten up on Friday because of their earnings report. Maybe they get some of that activity back later this year. The other side of this, of course, is the eviction moratoriums. That's also something that has not gotten a lot of press right now. It just happened over the weekend. But on Saturday, the eviction moratorium expired. Now, what does that mean? Well, for quite a few months now, individuals have not been able to legally be evicted from their house for not paying rent. All of a sudden now that is no longer the case, and this potentially puts millions of individual Americans at risk of eviction because they haven't been making payments up to this point. Now the question becomes, of course, have they been saving all their stimulus money and doing other things with it, like buying AMC stock and GameStop stock instead of paying rent? Well, maybe that's the case, and maybe they'll all just kind of cough. Oh, it's like, oh yeah, my rent's due. Here it is. Here's 6 months worth of rent. Or is there going to be a shift of people being forced out of their rental properties into the marketplace? And that potentially has some economic ramification, not a tremendous amount, but it's something at least worth paying attention to. But it may very well lead. Now, one thing that we have talked about before is that if I was a landlord, look, there's a lot of Americans that own a rental property or two rental properties outside of their normal job, right? It's just kind of their additional income source. And, there's a lot of Americans in this country that own these little rental properties just as additional income sources. And they've been tied up now for over a year, not collecting rent, still having to pay taxes. And prices for homes right now are still very elevated. One thing we could see from this, and look, there's no guarantee here, but one thing we could see is a lot of Americans that got tied up into their houses, these rental properties that they were running over the last year, say, you know what, I'm just going to take the higher prices in the market, sell the property at these higher prices. That potentially has the ramification of starting to shoot up inventories available for sale at a time that prices are beginning to peak in home prices. So again, there's a lot of things that can come out of this, but it's worth watching and paying attention to, particularly if you're long a lot of real estate stocks, long a lot of the market stocks right now, particularly in the month of August. There's a whole collusion of events from bills to everything else, and we'll talk about that when we come back from the break. RealInvestmentAdvice.com.
Trying to make ends meet. You're a slave to the money and you die.
Get daily investment news you can use, delivered at the speed of the internet at RealInvestmentAdvice.com.
Everybody get up!
Welcome back to the show. Of course, it is 6/17, first day of August, right? So markets are pointing up this morning at the open. Not surprising. First day of August always tends to be a little bit stronger. This is just simply because portfolio managers getting ready for the month, getting positions on their books. So again, first days of the month typically tend to at least open up stronger. The question is whether or not they can maintain it. But I did want to come back and talk a little bit about this whole issue of COVID and what's happening with the pandemic and the economy, because, this is the big concern, right? Is you've got literally almost 50% of the economy vaccinated. You got the other 50% that's not within margins of error here in terms of counting. And so you kind of got this stalemate right now between, the vaccinated, the unvaccinated. You've got a lot of political push to get people vaccinated. You've got a lot of other issues out there with people going, I don't really want to be vaccinated. If you live in Britain, apparently you just identify as a trans vegan because that will allow you to not be vaccinated. Not sure how that is, but according to a story this morning, a revelation that 500,000 vegans in the UK could be prevented from having to take mandatory workplace vaccinations due to their beliefs of being protected by employment law. Now, what employment law would protect a vegan? Well, vaccines are normally tested on animals. So if you're an ethical vegan, it violates your beliefs to be vaccinated because the vaccine was tested potentially, or should have been at least, tested on animals first. So,
well, it is being tested on animals.
Humans, yes, this is true. There's also the whole violation of the Geneva Convention of testing vaccines on humans without going through animal testing first. But that's a whole different story for another day. But I did like this tweet from Lawrence Fox this morning. It says, from this day forward, I self-identify as a trans vegan, which means I will only eat plant-based food and medium rare sirloin steaks, chicken, pork scratchings, and salami. So there you go. Hot dogs should fall in there because basically hot dogs are not real food.
I like the
menu. They're the best food on the planet, but don't really know what's in a hot dog.
Don't want to know.
Exactly. Don't want to watch the sausage get made? Definitely don't watch a hot dog get made. Not sure what goes into that. I think that goes right up there with Spam. Good stuff. Just don't want to know how it's made. Especially, why does it live in a can for 100 years and it's okay to eat?
We found cans of Spam on the battleship Texas. From the 1940s.
Did anybody eat in it?
Oh, no.
Why? It's probably still good.
Probably is.
Did you find any Twinkies?
But it's not. They didn't make those back then.
If they did, those would still be good. Anyway. So you're talking, but as we kind of get into this, the point is that as we were talking about earlier, the whole issue of this kind of COVID stalemate in the economy, of course, now with vaccination rates kind of stalling here and infections rising, the question is do people start making the decision to restrict activity in the economy? And that's going to be, potentially problematic, especially with the more lofty expectations of economic growth through the end of this year, which is what stocks have been pricing in ever since the beginning of this year. We started out at the beginning of this year with expectations of hugely strong economic growth this year, and that's what stocks have been pricing in. It's like, oh, well, if you've got, economic growth of, 14, 15%, whatever, right, you're going to have, exceptionally strong economic earnings growth, so we can overpay for stocks and earnings will catch up. And that's kind of been the premise, but earnings have not really come in. Sorry, let me rephrase that. Economic growth has not come in nearly as strong as expected, which also means that earnings are likely to start disappointing after this quarter. Now, why is this quarter so different? Well, because you're comparing against a quarter last year where we actually shut down economic activity. So when you're looking at earnings growth on a year-over-year basis, yeah, this quarter was going to look fantastic because you had no activity hardly in second quarter of last year versus this year. Now, next quarter, now we're comparing against a quarter of 30% economic growth. So year-over-year comparisons are going to become much more challenging in terms of trying to support valuations where they are. But, the important thing here is that we have an article out this morning on our website called A Grossly Defective Product. And kind of really going through this idea that,
when you're taking a look at GDP, how we report it, there's a lot of fallible measures to it. But most importantly, estimates missed by a mile. Atlanta Fed in April of this year thought that we were going to see economic growth of nearly 13.5%, came in at 6.5%, which is even below their lowest estimate of 7.6%. So, really this whole, method of economic growth and how we're calculating it obviously is not capturing what's really happening in the economy, and was overlooking a lot of the more obvious things, like a huge number of people sitting on the sidelines not working, collecting benefits, those type of things. So again, that doesn't contribute to economic growth. It's actually a drag on economic growth ultimately. But, as we, and the important thing here is again, kind of looking at this on a historical perspective and start talking about the annual change of growth. And this was the one thing. Now, look, this year, we're still going to have one of the stronger rates of economic growth going back to the 1990s. But it's substantially lower already than it was initially expected to be. And we're likely in this quarter have seen now the peak of economic growth for this year. So first quarter of this year, we saw about 6.1% economic growth. Quarter two was 6.35%. We're likely to see about a 3.5% growth rate in quarter three, and that's going to drop to around 2.5% by the time we get to quarter four. Next year, we're going to drop back in that 2% growth range that we've been in really since the beginning since the financial crisis. Every year, we just kind of chug out this 2% kind of growth rate. And that a lot of that has to do with the amount of debts, the deficits, all this that we've got going on in the economy that's suppressing economic growth. And that's not going to change. The things that we're doing, passing spending bills and, $1.5 trillion infrastructure packages and $3.5 trillion American Rescue Plans, it all sounds great on the surface, but it's all funded by debt. And debt ultimately detracts from economic growth. So yeah, you get these little spurts in economic growth because you throw a lot of stimulus into the markets. That's great, but it's not sustainable. And if you take a look at what's happening with savings rates right now, take a look at what's happening with personal incomes, those are all dropping back to normal trends of subpar growth rates. And that's because now all that extra stimulus has been spent, right? It's been spent, run its way through the system, and now it's leaving. So personal savings rates are declining, disposable incomes are dropping as we see more of this kind of stimulus come out of the system. So without more checks and without more direct payments to households, it's going to be very hard to sustain the rate of growth economically that we saw in the first and second quarter of this year. Really, even last year, we did almost $5 trillion worth of stimulus last year. That's just not sustainable going forward. But what we are left over with now is that great, we had this big boom of economic growth. That's awesome. Now we're stuck with the debt that has to be paid out over time. So, it's all fun and games until the bill comes due, right? And this is always the problem. And this is the kind of the mistake that politicians continue to repeat over and over again, is that, look, we'll use debt to fund this and create this activity. And that's fine. It creates a very short-term boost to economic activity. But when that little boost to economic activity is over, you're left with the debt. It's kind of like going out and, you don't have any money in the bank. You have one credit card with, with a bit of a balance on it. So you go out for the night. So you know what? Don't care anymore. We're going to go out, and you go out to a really nice restaurant and you have a $500 meal. You put it on the credit card. It's awesome. You go home, you feel great. You had a great time. It's awesome. You wake up the next morning and well, the dinner's over, but you're still left with the credit card bill when it comes due. And that's what we have going on in the system, is that we have this boost of excitement and economic activity. And so we all get excited. We run out and buy stocks, but we don't think about the consequence of what's coming, which is going to be the hangover effect of all this debt that we're going to have to deal with. And that's going to suppress ultimately economic growth rates and returns on capital, et cetera. And so when we take a look at where we are in this kind of new normal, and this is what people really overlook to a tremendous degree, is that if you look at the linear growth trend of the economy, so go back to 1947 when we first started tracking economic growth, and you take a look at the linear growth trend of the economy from 1947, it was growing at about 3.2% on an inflation-adjusted rate. And that linear growth trend held solid until 2007. And then in 2007, we had the financial crisis, instituted all this debt spending, right? And so we did recover ultimately, but that linear growth trend dropped down to about 2.2% growth rate. Post the financial crisis, post the COVID crisis, now we're going to get back. But the new trend of growth will be even lower than it was post the financial crisis. And that's just assuming we don't have another recession ever again, that we'll maintain this new lower rate of economic growth. But this is because of the debts and because of the deficits and the things we've gotten ourselves into. But see, we don't pay attention to these consequences of our actions. We just assume that, oh, we're back to 2% growth. We're good, right? 2% growth was never considered to be strong economic growth until post-financial crisis. Prior to the financial crisis, 2% growth rates was considered pre-recessionary. You had to be above 2% just to have escape velocity. Now we're just hoping to maintain 2% and calling that good enough. But it's not good enough. Take a look at what's happening with wealth inequality in the country, and you know exactly that it's not good enough. Be right back after the break.
Boy, it's more than I dare to think about. I just can't get you out of my head.
You're listening to The Real Investment Show.
So you know that for a while I've talked about the fact that I'm pretty convinced that Amazon and Google listen to our conversations, you know, either through our phones, computers, etc. Because, you know, you go talk about something and then some article or an ad pops up and says, hey,
yeah,
you know, I was just talking to my wife the other day about buying an RV. Totally joking. Now I'm getting ads everywhere about RVs for sale. I mean, my wife said if I ever buy an RV to make her drive around the country in retirement, that she'll divorce me in a minute. So,
not her idea of fun.
guaranteed out. Just joking, babe, if you're listening. But no, it's interesting. So we're just talking about COVID, right? So an article just pops up on Google this morning. Can masturbation boost your immune system to fight COVID?
What?
According to the Sun, right? People are looking for ways to boost their immune system, right?
Yes.
So they're looking to use immunity boosting supplements, you know, exercising more, eating right. Now, just by the way, eating right, exercising actually works to solve and to cure two of the leading causes of death in the country, right? Obesity and cardiac failure, right? Not locking down. I'm just saying we're not locking down the house because people overeat, right? Just have to lock up the fridges. But okay, I digress. Immunity boosting supplements, exercising, eating healthy, reducing stress, and quitting smoking are some of the common strategies to boost the immune system. But according to the Sun, now masturbating could be added to the list. Apparently, it increases your immune system 45 minutes afterwards. The study shows that men had more white blood cells in their system. And here's the good news. Department of Medical Psychology, University Clinic of Essen, Germany, right? These are where the findings came from. Dr. Felix Gersh, he's a gynecologist and obstetrician who specializes in women's health, said that chronic masturbation may not prevent COVID, but it certainly won't hurt you either. So there you go. See, this is what happens when you allow Google to listen to your conversations in the morning. That should not happen.
And no telling what's going to pop up now.
Exactly. Exactly. Oh, look at here. Ads for. Anyway,
Toys.
Seriously, back. This morning, Square. Of course, this is Jack Dorsey's other company, right? So if you didn't know this, Jack Dorsey, who's the CEO of Twitter, also launched a company called Square. Square is a payment system. And they have been, both companies are publicly traded, by the way. But this morning, he is making an acquisition or intending to make an acquisition of Australia's Afterpay for $29 billion. Now, here's the interesting thing about this, because I think it says a lot about where we are in the economy as a function. You know, we just looked at a year where you had a tremendous number of people receive money from the government to basically stay at home and spend money, right? So, you know, they got stimulus checks, they got extended unemployment benefits. Those are all running out next month, by the way, which will be another drag on the economy. But importantly, you know, the interesting thing here is one of the, you know, so now apparently everybody's good, right? We've all got money to spend. We've got these excess savings rates, disposable personal incomes were spiking. In fact, these social payments from the government made up as much as 40% of disposable personal incomes at the peak here a few months back. So what's interesting about this and what Afterpay does is they make installment loans, very small ones, into the marketplace. So in other words, you can buy something now and pay for it over the next, 4 months, 6 months, whatever, right? There's a lot of companies. It's not just Afterpay. There's a bunch of companies out there right now. And look, even some of your major players, JP Morgan, American Express, et cetera, have all moved into these kind of installment loan type payments plans. But, it just kind of goes to tell you that, this is the problem that will continue to plague the economy going forward, because if I've got all this money, why do I need installment plans? But more and more individuals are now moving into this market to where, I can have it today. And this is really one of the big changes economically. And we talk about the generation of the 60s and 70s. And we had, 8% growth rates in the economy. We had strong wages and high savings rates, et cetera, because people didn't have access to credit. Credit cards weren't a thing back then. My parents didn't have a credit card. They paid cash for everything. That was just their mentality. And it was that way until they died. I don't think my dad ever had a credit card. I don't ever remember my dad using a credit card his entire life, right? It was just a very different mentality. Everything was in the bank. It was in savings. They didn't invest. My parents did not invest in the markets, right? They kept everything in savings. A lot of it had to do with the crash in 1974. But again, just a very different mentality then. And, that mentality of my parents was you buy it when you can afford it and you save up for it. You find something you really want, you save up for it, then you go buy it. And that was kind of what was instilled in me. I don't use credit. We in my household, we pay for everything in cash. So, outside of a mortgage, right? My dad had a mortgage. I have a mortgage. But outside of that, we pay for cash, right? It's just the way we were raised. It's just a different mentality. And now today we've got this whole attitude. It's like, I've got to have it now. I can't wait to save up for it. I've got to have the new iPhone. I've got to have, the new this or the new that or the new computer, whatever it is. I got to have it today. I can't wait for it. I've got to have it today. Well, now these Afterpay systems say, great, buy it today. And you can pay for it over the next 4 months, whatever, right? And so it allows people access to things. But, this is all fine and dandy until you get into a situation where people can't make the payments. And of course, when we have a real recession, when we have a position to where the government's going to not bail everything out at some point, or choose not to bail you out, they may bail out the big banks, but they're not going to bail, little guys out, then that becomes a problem. But again, it's just kind of more of this whole idea of, when we talk about economic growth and we talk about how strong the economy is, well, is it really that strong if really the consumption that's driving the economy is all built upon a pull forward system, right? I'm spending money today I don't have, but I've got to pay for it in the future. So those payments eventually come due, right? The question is just when and what's the function. But again, great. If I'm loaning, but here's the thing, right? So I'm loaning you money today. I'm saying, okay, do you want to go buy this? And so this is the way Afterpay works. I want you to think about this for a second, because Afterpay has to make money. So how does Afterpay make money? So Afterpay says, look, if you buy something today and you can pay for it over the next 4 installments, interest-free. Okay, great. They're not making any money on the money they just gave you. So where do they make their money? They make their money when you miss a payment. So what this whole plan is based on is late fees, which means that there's a tremendous number of people out there that take out these Afterpay loans and miss payments. Back in 2008, you probably don't remember this. Now it's, because it was an eon ago at this point. After the financial crisis in 2008 and the housing market blew up, the government stepped in and said, hey, we're going to help homeowners stay in their houses. We don't want homeowners to lose their houses. Now, these were people that bought houses they couldn't afford. But now we came up with this great idea to lock people into the houses they couldn't afford instead of evicting, saying, hey, look, you can't afford that house. You need to file for, bankruptcy, mail the keys back into the mortgage company and go find a job in a better state. You live in Detroit where there's no work. You can now move to another state and find work, get yourself back on your feet. No, we didn't do that. We said, okay, tell you what we're going to do. You bought a house you can't afford, but we don't want the mortgage market and the bank, more importantly, the bank, heaven forbid the mortgage company, we don't want the banks to have to take these houses back. So we're going to create these 2 programs called HAMP and HARP to keep you in that house. So we're going to refinance your mortgage for you at an ultra low rate, and we're going to try to get you set up so you can maintain that house that you bought that you couldn't afford. And the vast majority of those HAMP and HARP refinancings failed again. More government dollars wasted. But the important thing is that people that were in Detroit where there was no work, they were locked into their house. Yeah, they refinanced their house. But now they're locked into it in a city where they can't get a job. So, of course, they redefaulted. By the way, a lot of those houses are still in the books of banks that are marked as paid because we don't have mark-to-market anymore. Anyway, I think what's interesting about the acquisition by Square is it tells you a lot about where we are in the economy. Probably be a good acquisition for Square. Gives them another revenue stream, gives them an ability to add another service to their payment system. So, I think the stock's going to be down about $12 this morning on the news, but probably good for them long term in terms of acquisition. But I think it tells you a lot about the financial stability of the system as well. Be right back after the break.
Very superstitious. Let us fight the fall. 13 model baby. Broken looking glass. 7 years so bad love.
You're listening to The Real Investment Show.
Welcome back to the show this morning. It is 6:47 as we get ready to wrap up today's Monday edition, first day of August edition of the Real Investment Show. It's been an interesting show this morning.
Never a dull moment.
So many things I could say right now. We're just going to be good. Couple of other things going on this morning. Of course, it is first day of August, as we talked about early in the show this morning. August tends to be one of the weaker months of the year. September also tends to be one of the weaker months of the year. So the risk of a correction here over the next month or so has certainly picked up gains. And as we noted in this past weekend's newsletter on the website, we've had a period of 6 straight months of gains in the markets. Now, is that unprecedented? No. Is it unusual? Yes. Can it go longer than 6 months? Absolutely. But you are getting into one of the longer stretches of the markets right now without a correction. Now, don't freak out. That doesn't mean, we're about to have the next 35% meltdown in the market. It's not saying that at all, but a 5 to 10% correction is a norm within any given year, and you haven't had one since last year this time, right? So we had a pretty long stretch without a pickup in volatility. What could cause it? Who knows, right? Nobody really knows. I mean, could it be COVID? Sure. Could be a bunch of people not showing up for work, boosting their immune system. I mean, could be a lot of things, right? It's always that unexpected environment where something happens that we're not planning on. A whole rash of companies missing earnings all of a sudden. I mean, it could be a lot of things. You just don't know what it is, right? So this is why, when you take a look, and this is the problem with technical analysis, right? When people use technical analysis, they try it. They say, okay, I'm gonna use this thing of technical analysis. And, some guy on the radio said it always works. Nothing works 100% of the time. What works 100% of the time is sticking to a strategy that has a history of working more often than not. But just because something doesn't occur because you think it should occur, i.e., as an example, we've had 6 straight months of a market being up. August usually is a negative month, has a track record of that. Should we have a correction this month? Possible. But just because it doesn't happen doesn't mean the analysis is broken. It just means that the markets are doing something abnormal. So you have to stay with your discipline as long as your discipline has a track record of working. Now, I mean, there's a lot of disciplines that are just stupid that I've seen out there, right? But in bull markets, a lot of things, even stupid strategies, work in a bull market. So again, it's important to make sure your strategy has performed in both a good market and a bad market. But this is just kind of where we are. And again, again, with August, it's not uncommon to have a correction, just something to be aware of. Does that mean you should be in cash right now? No, that's not what it means. And the first day of August tends to be positive. First day of every month tends to be positive because it's just positioning for the month. People kind of loading up their books, getting ready for the month. So not surprising, today's an update. But interestingly enough, about 2-3 weeks ago, I told y'all at the beginning of this year that I've got an experiment running on Bitcoin. And a couple of weeks ago when Bitcoin was violating 30,000, I was like, okay, I'm about to pull the plug on this. This is stupid. And so I went to log into my account to sell it, and I got locked out of my account. And just because the password had expired and blah, blah, blah. So I had to log back in and go through this whole re-verification process. And so this whole re-verification process took like 2 weeks to get straightened out. Yeah. Which is fortunate because I didn't get to sell my Bitcoin. Now it's up over 40,000. So the experiment still runs. I'll let it run through. My goal is to let it run through the end of the year. We'll see if I make it. It's been, so we're starting 8 months now. Yeah. So we're making some money. I mean, we're making some money on the trade, but we'll see how this all works out. Because I started this on January the 1st. So we'll see how the year turns out in terms of its movements. But, as again, what Bitcoin really kind of represents is a shift of the speculative mentality. There for a while, it was all about meme stocks, right? AMC and GameStop, and that was in the headlines every day. And apparently that's lost some luster because there was an interesting chart out this morning showing the number of mentions on Wall Street Bets about AMC, which has basically gone away. And that whole push AMC to the moon has faded and has kind of all shifted back towards cryptocurrency. And again, it's just, this kind of goes back to that speculative mentality of the market. These speculators are just kind of popping around different areas of the market looking for opportunity and, kind of piling into it. And Bitcoin was pretty beaten up, and they all kind of piled back into that and have now run that price back up. And I'm presuming that probably over the next few weeks that we'll be talking about, oh, it's AMC again or GameStop or some other, meme stock that has gotten the attention of online traders. Now, the one interesting thing about this, though, is that a lot of that speculative trading was really kind of pushed by, both Robinhood, which was the online trading app, Wall Street Bets, which was the kind of the community hub website of Reddit investors that were chasing a lot of these stocks. And that was all combined with the shutdown of the economy because didn't have access to sports betting and, all these stimulus checks. Had all this money, needed something to do with it, and I didn't have to pay rent. So why not invest it into the markets, right? Well, all that's kind of reversing now. Rents are due. Stimulus checks are fading. And, the issue of the market may become a lot more challenging. Markets while markets have kind of ground their way higher this year, it's been a pretty volatile run. I mean, it's been a lot of little dips along the way. It's been kind of slow. It's been a slow grind higher. And, that kind of loses its luster when it's not fast money overnight. You're not making 20 or 30% overnight, right? So it's kind of losing its luster at this point. So you're starting to see the volume of trading dry up here a bit. You're starting to see some of that enthusiasm kind of back off here a bit. But again, still a lot of it out there. Don't mistake me. But again, right now, it all seems to be kind of migrating back towards Bitcoin, which just broke out of a big consolidation range that had been in really since going back to May when I started trying to sell my coin and couldn't. So it broke out to the upside. We'll see where it goes to from here. But again, just kind of goes back into this whole idea of really kind of the markets and kind of where we are. Now, Fed Governor Lael Brainerd, she's one of the Fed speakers. She suggested late on Friday that the central bank likely won't announce any bond purchasing tapering at Jackson Hole. That's also giving a lift to the markets this morning. Again, what the Fed does is they trot out all these different Fed speakers to say contradicting things, and this just kind of keeps the market trying to guess. Right? Is it are they going to announce taper? They're not going to announce taper, and so they kind of float these little things out there to see how the market responds to it. So, somebody comes out, one of the Fed speakers says, "Yeah, we're probably going to taper," and the market sells off, and then you get another Fed speaker right behind there and says, "Oh no, we're not going to taper at all," and then the market runs back up again. So it's just the Fed really trying to figure out the temperature of the markets, potentially what they can get away with. And I think that my personal opinion is I think that next month when we have, late August, I said next month, I'm still in July. Later this month when we have Jackson Hole, I think that there's a real possibility that the Fed won't announce official taper, but they'll talk about the need to potentially taper as they start to approach full employment, as we get inflation at target levels, et cetera. They'll start talking about tapering and make it a more official process. And again, we'll see what comes out again. But I think the jobs report for July will be important. That we'll see that later on this week. We'll see how that number is looking, particularly for August as well. When we get that in September, they'll tell us a lot. And I think really if we start to see employment improving a lot here, and one of the reasons why we'll see and look, over the next couple of months, we could see a fairly sharp jump in jobs, because now that the eviction moratorium is off and unemployment benefits are running out, Google searches for job openings has spiked, not surprising. So, all these record job openings we have, a lot of people are going to be looking to fill those pretty quick. So I think we could see the next couple of months, we could see some fairly strong jobs numbers. That's not going to be that bullish for the markets, because if you have fairly strong job numbers, then that's going to push the Fed more towards tapering than not. So strong jobs, not necessarily good for the markets. And that's one thing you'll just kind of want to pay attention to. And again, just pay attention to what's going on now with what's happening with these COVID cases and potentially, more actions coming out of the government, or, are they going to shut down the economy? No, but I don't think they will. Definitely not in Texas, Arizona, those states for sure. But I think you'd very well see self-imposed lockdowns by individuals, which could impact economic growth and slow spending down and slow some of the other things down that we've been kind of basing earnings expectations on, as well as we head into third quarter and fourth quarter this year. So again, just things to kind of pay attention to here as we get into the new month. But again, the risk of a correction here stands. So don't be overly aggressive here. Stay invested, but just make sure you're managing your risk accordingly. If you have any questions, get by the website, need help, need a review, always happy to help you. RealInvestmentAdvice.com. Our latest newsletter is out as well. It's on the website now, RealInvestmentAdvice.com. We'll see you tomorrow.
Money, 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 always Sunday in the rich man's world. All the things I could do.
Get daily investment news you can use, delivered at the speed of the internet. Sign up for the Real Investment Report now at realinvestmentadvice.com.
It's a rich man's world.